this is where this will generally be like the income structure for you. If your income is above $500,000, then you start thinking about, okay, we've got to start at that point to get some income diverted so that it's not all rolling up to your personal tax return. And I'm talking about taxable income. So we can already do things like using real estate investments to offset your income. And if that keeps your income below 500,000, then great. We don't need to go to a more advanced tax strategy. But sometimes we can't, or sometimes the income is so high that even with these deductions, we're still above 500,000. And that's where we start to get phased out of credits, and we start to be in such punitive tax brackets that we just don't want additional dollars of income flowing up to your personal return. So we'll look generally at that point to break some aspect of the business out. Oftentimes it's payroll, where you've got a business that has payroll in it. Let's open a separate company that runs the payroll for that company, and that lets us create another entity that's completely off of this, like outside of this funnel where everything is ultimately going up to you and to your tax return, and it lets us get it over onto a separate return where we have generally a C corporation. The C corporation is taxed at a flat 21%, and doesn't have a lot of the extra little high income earner taxes like you do on your personal return, where if you're above certain thresholds, you get like ding, you just get this extra little 4% net investment earners income tax that gets tacked on there. So we'll use a C corp generally to divert income away from your personal return if you're above $500,000. And then another one to consider, although honestly, it's not a first option, but if we don't have any other way of matching up passive losses from real estate investments with ordinary income from business income, then one of the options is to look at a trust with, it's called a beneficiary deferred income trust. And it essentially has your kids as the beneficiaries, and it has some portion of ownership in this family company. So the income is going there, and that's passive income. And it has some portion of ownership in your ordinary business structure. And that income, even though it's ordinary income to you, it's passive income to the trust. And that lets us match up some portion of your income with these losses from real estate so that we can actually use that real estate as an advantage. But both of these that I just went over are really, again, for over 500,000. If you're under 500,000, keep it simple. Have one S corporation that you own completely, one family management company. The S corporation is for everything that's business related income, ordinary income, and the holding company, family management company, is for everything that's passive, including real estate. After we get the entity structures figured out, then we move on to deductions. And we need to, if you've watched any of my trainings before, I always say this, but we need to ask how, not if. So we need to figure out how we can deduct the major expenses in our lives. In order to deduct something, it has to be both ordinary and necessary. And then it's up to us to figure out how to do that. And again, this is why we need to be having these conversations now while we still have time to actually change the structure and create the circumstances in which these expenses would be ordinary and necessary for your business. So I've put just a quick list here of the things that we generally want to make sure that we're deducting. And these are the major expenses of your lives. Deducting your house, your cars, recreational vehicles, kids' college, state taxes, and then investments. And basically make sure that investing, like we just talked about real estate, but investing should also be done above the line. What we're trying to do is have your income and then have your expenses and then have your investments all be above this line, so to speak, so that then your taxable income is smaller, as opposed to the way that most people do it, which is they have their income, which is their taxable income, and then they pay their expenses, and invest with what's left over. And that, of course, leaves a larger amount for tax and a smaller amount for expenses, and more importantly, a smaller amount for investments. So we're trying to think proactively about those things and say, where's our money going? What are the major investments we're making? What are major expenses you have? And let's shift those up so that they're above the line. All right. Fourth, and finally, is we want to defer profits till next year if we can. So, and to know that, we also want to have an idea of what's coming next year. So we want to be this idea of situational awareness and getting a projection done. I mean, I know that next year hasn't started, and I own a business, so I know how much of a question mark there is in deciding or predicting how much is going to be made next year. But we have some idea, right? And so we want to figure out, okay, well, what's coming next year? And if we know something major is coming, then we want to plan for that. And there might be a reason why we actually don't want to defer profit into next year, because we know that next year already is going to have something huge in it. But generally speaking, if there's revenue, we're coming up on this December 31st line in the sand. And if we have the opportunity to push revenue out until next year, so if someone, if a customer sends you a big check and you have the option to deposit that the last week of December or to push it to January, then push it to January. Or sometimes you can have these conversations with your customers and say, hey, let's wait on that payment till January. And then we can also bring expenses forward. So I would never recommend spending money that you wouldn't spend anyway, just to get a deduction. But if there's money that you are going to spend anyway, but you would spend it in January or February of 2023, then at least consider spending that money a little bit early to shift that expense to this year to pull your income down. And in doing that, essentially, you're pushing the profits out a year, and you get the time value of money, which can be pretty substantial, on keeping that profit and the tax on that profit for an extra year. So this deferring profits till next year is probably the least important as an ongoing strategy. We have many clients who don't do this at all, and it's because they've done everything else. Their expenses and their investments are above the line. They have the right entity structures, and so at the end of the year, there's not a scramble to do this. But sometimes, and again, this comes back to the situational awareness. You're at a spot where there's nothing. You've done everything you can, and you're at the spot where you're maybe phasing out of the child tax credits, or you're phasing out of the qualified business income deduction, where like pulling your income down doesn't just benefit you on the tax rate itself. Is not just a question of 32 cents on the dollar for the federal tax rate. It's qualifying for these other incentives. So these can be pretty significant. But again, with a good projection and knowing what's coming, that gives you the option to look at this and say, okay, well, how far do I need to go? And then figure out a way to get there. And these are some of the options you can consider carefully on how to get there. Okay, could we defer some of this revenue till next year? Could we bring some of the expenses from next year into this year? Prepay our rents, or prepay our, there are a lot of agency owners out there who will prepay some ad spend, and pay like significant deposits into Google and Facebook. They're going to use that money up over the next month or two anyway. But this brings a big expense into December and helps them drop that profit down at the end of the year. And the other thing to be careful about, but you can do, is switching to accrual accounting instead of cash basis accounting. And that really comes into play if you have received cash or sales for services that you haven't fulfilled yet. So if someone paid you a really big deposit for services that are going to be performed, well into 2024, then it might make sense to consider switching to an accrual-based accounting so that you can record that revenue as unearned income instead of counting it as income when you really have yet to perform the work for it. But be careful about that. It can get tricky. All right, that is it. So let's see, what questions do we have? Let me hold this up. Okay, Shannon is thinking about buying a car. Should I buy before the end of the year or wait until next year? Really good question, Shannon. So I don't know what your projection looks like. It's going to be really important for you to understand what that projection does look like. So, for example, if you're in decent shape for 2023 and you're not needing the deduction this year, you're at 22% tax bracket and you're going to be at the 22% tax bracket anyway. You could deduct the full value of the car. I guess I'm making an assumption there. I'm assuming, is this like an SUV or it's an SUV or a car? Is it over 6,000 pounds? I guess I'll ask it that way. But you could deduct the car this year, and you know exactly what it's going to save you, 22%. But if you're in a spot where your income is actually going up and you're looking at a higher income next year, then you may want to wait till next year. So it's a tough question for me to answer without knowing a little bit more about your situation. And I think Shannon submitted this question online before, so I'm not even sure if she's on this live stream or not. But that would be the thing to consider, frankly. One of the things to always, I like to time vehicle purchases with real estate purchases where it's possible. So one of the major things to consider would be, if you're planning on buying a house next year, then you might want to wait till next year. Or if you're planning on using next year's tax return to buy a house, then you might want to wait till next year. Because one of the things that we always run into is business owners who want to show a higher income for purposes of getting a mortgage, but don't obviously want to pay the extra tax on that income. And one of the ways to get around that is with vehicle purchase or some other kind of equipment or depreciable asset purchase, because you'll have your taxable income and you can pull that down with the purchase of a car or an SUV. But the way that you're actually pulling that down is by depreciating the car. And so this is called depreciation. And the banks will actually add back the depreciation. So your taxable income ends up down here. But when the banks look at it, they're going to add that back and calculate your income based on your income before the depreciation. So that would be one thing to consider if it's applicable. If not, you just need to look at it. And all other things equal, if your income is going to be about the same this year, next year, then there's really no reason to wait until next year. You can go ahead and purchase it this year. But if you have something coming like a house purchase, then wait till next year. Okay. Craig. Okay, another Craig. And how do you deduct a car purchase not used that is used at 20%? Good question, Craig. And let's see, Craig, I apologize. I did get your message previously. I've just been meaning to get back to it. So I apologize for not getting an answer this sooner. But 20% is, there's another like line of demarcation here, which is 50% business use. And under 50% business use, you are not, I guess, whatever. I'm messing up my signals. Anyway, under 50% business use, you only have one option, and that is to take mileage. And that usually is not a very good option, because if you were putting on that many miles, you would probably be over 50% business use. So the way that I would put that back to you, Craig, is how can we get your business use over 50%? Because if we're over 50%, now you have the option to take mileage or actuals, like actual expenses. And so actual expenses includes gas, maintenance, and the big one, which is the depreciation on the car itself. So the way that I would look at that question, Craig, is especially for year one. Like, can you do a 1 year sprint? I know you bought this partway through the year. So is there a way that we can either reduce the amount of personal miles you're putting on the car or increase the business miles or change what is a business mile? Like change your circumstances in a way to increase the number of business miles. So without revealing too much of your situation, although I guess, your name isn't on here, so this is somewhat anonymous anyway. But we would want to use an accountable plan to make your home an administrative home office. So that's step one, is we have an accountable plan. That makes this your home. And there's a crappy driveway. Looks like a sidewalk. But anyway, this is your home. So we want to make that into a home office so that when you pull out of your driveway, going anywhere for business, we are accruing business miles. And then step two is we need a business destination that is on your daily route. So the most common one that we'll use or recommend using is that you get a mailbox for your business. So UPS store box or a PO box even, or like a virtual mailbox. And we put that wherever your daily route, we find the one that is the absolute closest and most convenient to where you would be going anyway. So maybe, every day you're going to drop kids off at school or going to, another job or to see a client. We want to have a business destination that's right next to it, so that when you leave your driveway, you're going to from an administrative home office to another business destination. And now from time to switch colors, I think. And now from point A to point B are business miles, and that's the majority of your miles. And then from point B to point C, yeah, fine. This is personal, but that's fine because it's only the minority piece of the miles. So that's generally the way to do it, and that will get us up over that 50% threshold generally. And that makes you eligible for depreciation. And I will also reply to your other message, Craig, and make sure that you're totally taken care of. But if you want any additional clarification, feel free to put it in the chat here. Okay. Annette, how do you make investments so they qualify as above the line pre-tax? Great question, Annette. There are a couple of ways, and it really depends on the investment. But okay, it depends on what you want to invest in. So let's just say you are wanting to invest in real estate. The key with real estate is we want to make sure that we are taking advantage of depreciation as much as possible, so we can carve out as big a chunk of this property as we can, and then invest it, and then take it as an expense against your other income so that they wash out to zero. And that then, by offsetting your income, saves tax and amplifies the power of that investment, because let's just say you invest, I don't know, $200,000 into a property, and you're able to take, by doing like a cost segregation study, you're able to take an accelerated piece of that for depreciation this year, maybe as much as like $50,000. So we have a $50,000 deduction. The key is going to be that this deduction is passive, and generally we have ordinary income. But that is something that there are a number of ways that we can overcome it. We can use the real estate professional exemption if it applies. If income is below the threshold, which is about $100,000, then we can just take some of that anyway. And then if not, then if neither of those two apply, then that's where we might use a trust. But we want to find $50,000 of ordinary income that we can offset that with. And now we've got the benefit of wiping away that 50 with this 50. And generally speaking, that's going to have, let's say, if we're assuming like a 30% tax rate here, then we're at like a $15,000. We've saved $15,000 in tax by doing this. So the down payment on that 200, let's just say 20. Well, let's say it was the same 25%. Let's say it was a $50,000 down payment as well. But now net of taxes, it only actually cost $35,000 to get into that $200,000 property. Of course, we have the debt associated there too, but it amplifies the investment that we have for the amount of actual cash that it takes to get into it. Or thinking of it differently, now we have $15,000 to go and help apply towards the next investment to do the same thing over and over again. And to pick a non-real estate example, if we're thinking about like, brokerage fund, this would be, it can be as simple as putting it into I'm going to go back here to my entity structure example. It could be as simple as putting it into a retirement account. A lot of times, frankly, I don't love retirement accounts because they're so restricted. When we're looking for investments, there are usually three things we're looking for. One, we want something that you have some expertise in. Two, we want something that you have control over. And then three, we want something that you have the ability to leverage either other people's money or other people's time to help amplify the returns on that investment. Expertise and control help you limit risk and amplify the return. Leverage increases risk a little bit, but also helps you amplify the return on investment. So, which of those you use is up to you. But retirement accounts are generally something you don't have expertise in, you don't have control over, or at least traditional retirement accounts invested into brokerage funds are something you don't have expertise in, don't have control over, and can't lever. Although I guess the tax benefit is a little bit of a lever. But at least if you're putting money into retirement funds, we want the tax benefits either now or down the road, whether that's the Roth or traditional. But putting money into, let's say, a brokerage fund after tax is something where you don't have expertise. Maybe you have a little bit more control. You don't have the ability to lever it, and you're not getting any tax benefit from it. So that's not to say never do it, but it should be done really more to diversify than anything else. And the other category of investments, which frankly is often overlooked, is investing back into ordinary businesses. So the reason why the real estate gets so much attention is exactly because of that ability to like have that tax, have a big chunk of it be above the line and come back to you pre-tax or offset your taxable income. The one that I think is most often overlooked, and it's because people think of it as more risky, and it is, I suppose, inherently a little bit more risky in the sense that it's not always tangible. But investing into other business activities is usually one, allows you to take advantage of all three of these things: expertise, control, and leverage. And for that reason, has better returns. And the investment into a business is tax deductible. It's essentially 100%. We don't have to play the game of getting a cost segregation study and then taking a portion of it. Usually it's 100% deductible, as long as we can avoid getting it classified as startup costs. So there's a lot in there, Annette, but I hope that has been somewhat helpful. Let's see, Jenny, does this work for real estate you buy and use as a short-term rental? Yes, Jenny, it does. There's nothing that I said. Where was it? There's nothing that I said in this discussion about real estate that wouldn't apply to a short-term rental. There is the possible exception with a short-term rental of it being ordinary income instead of passive income, which would be great. But you just have to be really careful with that. There are some just because it's short term doesn't mean that it is ordinary. Essentially, for it to be ordinary, it would need to be more than just real estate that people are renting. So more along the lines of like a hotel with services, and where people are paying for not just the like staying at a hotel, but you're paying for the breakfast and you're paying for the gym and you're paying for the cleaning and the whatever it is. So in some cases you can set up a short-term rental. You just have to be really, really careful that your agreements and everything is structured in that way to make it so that the services you're providing are a significant portion of what people are paying for, beyond just the staying a night in an Airbnb. But even if you don't do that, let's just assume this is short term, but it is still going to be passive. Everything I said previously would still apply. And that would just include the part about making sure that if you have this passive loss, that you're thinking proactively in a way, and so that you can strategize to make sure that your passive loss is offsetting ordinary income, either by having someone in your family who can be qualified as is between spouses, having one spouse or the other who can be qualified as a real estate professional in order to make that loss ordinary, or be able to carve off a chunk of what would otherwise be ordinary income and figure out how to turn that into passive income. Okay, TJ asked, what, if any, of these strategies apply if business income is lower than approximately 30,000 S Corp threshold and entity structure is a basic LLC? Great question, TJ. What of these would apply? The entity structure piece would not apply because you're just not at that level of complexity yet. But the above the line piece absolutely qualifies, making sure that everything that you are spending money on, that you can find a way legally to qualify as ordinary and necessary, that you're sweeping that into the business. And this isn't, again, about spending money you wouldn't otherwise spend anyway. This is about taking money that you are spending anyway and making sure that you have structured things correctly, like we talked about with Craig and his car, structuring it in a way to say the money is going to be spent regardless. Let's structure it so that we have an ordinary and necessary business expense rather than a personal expense. Because you can still, even with everything you described, you can still pull that 30,000 down to 20,000 or down to 15,000 by sweeping more deductions in legally to offset that income. All right, let's see. I think that looks like everything. Any other questions?
Yeah, Jenny has one. Does this work for real estate you buy to
Oh,
use?
yeah, I
Got it?
think I had just answered that one. Does
Oh,
this work real estate buy to use a short term? Yes. So that was one I answered right before TJ's.
sorry about that.
No worries. Okay. Thanks, TJ. All right. If there are no other questions, then we will go ahead and wrap up. Thank you so much, everyone, for joining. And if you do have any other questions, as always, feel free to shoot me a message. Although Craig I'm a bit of a hypocrite on that, but I will send you a more full response on that either this evening or tomorrow. Um, oh, okay, let's see, TJ, one more question in the Q&A box. Let's see. Oh, here we go. Yep. To build on that, do those deductions have to be as of the date the LLC was formed, or can they be prior? Okay, good question, TJ. So we've got, essentially an LLC that might have been formed. Let's just say an LLC was formed in April. It doesn't really matter. This is just for example's sake. And this is the LLC formation date, but we might have expenses or even potentially some revenue that predate that earlier in the year. And so obviously everything after that in the year is deductible as expenses. And the question is, what do we do with the revenue, with the expenses specifically, but also revenue that happened to that previously in the year? I recommend sweeping everything in. I say this is all part of the same. This is all part of the same business. The fact that your LLC was formed in April is a legal question, but your filing, especially in the circumstance that you gave, TJ, where you're filing as a sole proprietor, the activity on one side of that line would be a sole proprietor, and the activity on the other side would also be a sole proprietor. So there's no sense in creating what would be two Schedule Cs that would go on the same tax return, one for before and one for after. Just roll it all together. The LLC date is in, April. Great, whatever. Let's not overthink this. Let's just have everything be in 1 year. The LLC was formed. You've got it there. What the IRS cares about, the IRS cares surprisingly little about like the actual bank account an expense cleared through, or the name that it was put on a vehicle purchase, whether it was bought in the company's name or your personal name. They don't care about that actually at all. What they care about is whether it was used for a business purpose. So as long as you meet the ordinary and necessary criteria, and you are using it for, it went to a legitimate business expense, then deduct it, regardless of which side of that line the expense fell on, relative to the formation date of the LLC. Perfect. Okay, Craig, I'll keep an eye out for your other email. Can that go back to 2022 or just 2023? Great question. It cannot go back to 2022. So that piece, unfortunately, whatever happened in 2022, separate tax year. We can only take what happened in 2023. And so this would apply from January 23, but nothing like anything before that is off limits. Okay. All right. Perfect. Well, thanks again, everyone. We'll be off next week for Thanksgiving. I hope you all have a wonderful Thanksgiving. And again, just don't hesitate to send over any questions that you have between now and then. Have a great holiday. Be safe, and we'll see you back in 2 weeks.